I like that people are cutting price targets. That's a time when I think you need to take a step back, reassess your ratings and your recommendations, and it looks like an opportunity to me. In this kind of market environment, I think investors are looking for assets like Netflix. A great value they're delivering to subscribers, very high subscription renewal rates, lots of pricing power. And what I like about the earnings story from here is I think losses peak over the next year, and we really start to see the leverage that from the content investments that Netflix has been making over the last 3 years. And that's the story that I really like to see here, is a doubling of earnings, real earnings story going forward over the next 2 or 3 years.
Rising rates were seen as a reason for some of the target cuts.
Yep.
You don't see that as a risk?
I think it's factored in at these levels. That's our view. Valuation looking very attractive, at these levels. So, yeah.
Brian, does Netflix need perfection in this earnings report in this environment, or has the stock fallen enough that just pretty good will be good enough? I mean, there have been some quarters when you need to see not only the international subscriber numbers be high, but also domestic outperform what some had at one point thought was a saturated market.
Yeah, so I never look at Netflix as a trade into the quarter. Absolutely not. And, I think what we saw last quarter was probably the biggest miss of any company I've ever followed in terms of a top line number, 17% miss on net subscription ads. So I think the story, generally is positive, a lot of content. They're doing a great job with their margins. Subscriber growth is actually strong. They just overestimated what it was going to be last quarter. So I think it's a great secular story. I just never play Netflix for a quarter.
Mark, you also put out a note today about Amazon and specifically about those proposed rate increases from the U.S. Postal Service last week. Shipping costs, how should we think about that, especially with the fact that the Postal Service is looking to increase rates at the highest level since the early 90s?
We estimate about a third, 30% of Amazon's outbound shipping in the U.S. is sent through the Postal Service, the remainder through FedEx, UPS, and the other regional carriers. If you apply about a 10% price increase that they propose on average, you're looking at about $1 billion in incremental costs next year for Amazon. So it's a big number. However, Amazon has a lot of things that they can offset that by. For instance, they just raised their Prime subscription fee by $20 in the U.S. That alone will add an incremental $1.5 billion in additional revenue in year one. That alone will cover this Postal Service fee increase. There are a lot of other things that they can pull levers, including just passing them along through higher fees, which they've done in the past without seeing an impact on their business. So it's a big number. It could be a big impact, but Amazon has a lot of levers to pull.